This is an axolotl, an amazing and fascinating species native to Mexico. They have the incredible ability to regrow lost body parts and remain youthful throughout their entire lives. Probably Brian Johnson and Kate's favorite cages, if you know what I mean. But jokes aside, this curious little animal has a surprising connection to some much bigger ideas. In this video, I'll show you how the axolotl is linked to crypto, the Adhishthana principles, and the future of AI. Ever since launching Adhishthana, I have received a tremendous amount of appreciation from people across many different domains. One of the reasons for that is because the applications of the principles are surprisingly broad. Over the last year alone, we have applied these principles to financial markets, nuclear energy, natural calamities, space events, technological transitions, man-made disasters, and several other domains. If you have not watched our previous video on the Telegraph, I would definitely recommend checking it out. Now, because we have explored so many different areas, we naturally receive a lot of requests from people asking us to apply the framework somewhere else. One of the most common requests was, can Adhishthana principles be applied to cryptocurrency markets? And interestingly, this was a question we ourselves wanted to answer, not through theory, not through opinions, but through an actual experiment. At the same time, there was another question we kept receiving. Can somebody with a very small amount of capital actually use Adhishthana principles? This question comes up quite often because our positioning naturally attracts institutional participants and high net worth individuals. However, the principles themselves are universal. So if the framework works, and it does, so it should work at all scales. So we decided to test both questions simultaneously, and then we decided to make things more slightly interesting. To do that, we added AI. More specifically, we wanted to know what would happen if an advanced AI reasoning model was trained on the Adhishthana framework and then allowed to independently identify a trade. We were going to let AI think on its own, and that decision turned out to be quite interesting. But before we get there, let's start from the beginning. Building the experiment. One of the biggest challenges when applying Adhishthana principles to cryptocurrencies is determining the correct starting point. For traditional financial assets like shares, the process is relatively straightforward. The listing date becomes the date from which the phase mapping starts. But for cryptocurrencies, it becomes much more complicated. The same asset may be listed on multiple exchanges at different times, so the historical records are quite fragmented. And because phase mapping relies heavily on understanding the complete life cycle of an asset, the question of where exactly a cryptocurrency begins becomes surprisingly important. So, before placing even a single trade, we spent a considerable amount of time researching different data sets and testing different approaches. After extensive analysis, we found out that the spot market data provided the most consistent results when applying the framework on crypto assets. Once we established that methodology, we designed the experiment. We created a dedicated trading sub account and we funded it with approximately $30. Yeah, not 30,000, not 300,000, 30. The objective was not to flex money, but rather to test the questions. The experiment was divided into two stages. In stage 1, we would execute 18 trades using Adhishthana based analysis. Why 18? Because there are 18 phases in the Adhishthana cycle, so 18 was the perfect number for us. In stage 2, we would train an advanced AI reasoning model on the same framework and allow it independently to identify one trade. The purpose was not to prove that humans are smarter than AI, nor was it to prove the opposite. The purpose was to understand what happens when an AI model is allowed to think independently. Stage 1. Over the following weeks, we executed 18 trades across multiple cryptocurrencies. All of the trades were taken in perpetual futures, 15 of those trades were short positions, 3 were long positions. Every trade was based on the Adhishthana principles, and the results were quite promising. We had a 100% win rate. Each trade that we took was profitable. By the end of the 18th trade, the account had grown from approximately $30 to around $110, a gain of more than 260%. Now, before somebody points out that $110 is not a lot of money, yes, that is true, but that was never the point. The purpose of the experiment was not to create a large account. The purpose was to determine whether the framework itself could function effectively with very limited capital. At least within this experiment, the answer appeared to be yes. On your screen, you can now see a visual representation of all the 18 trades. Each green sphere represents a complete trade. The larger the sphere, the larger the profit generated on that trade. Rather than focusing on individual position, focus on the overall structure. Focus on the consistency, focus on how the account evolved over time. At this point, stage 1 was complete. The framework had performed, and now it was time for stage 2, training the AI. The Adhishthana principles are not something that can be understood through a 2-line prompt. Even for you as a viewer, you might not fully understand what the Adhishthana principles are, unless you have read my research papers, my articles, and most importantly, my book. The point is, you need a significant amount of context to understand the principles. So before asking the AI model to generate a trade, we provided it with a substantial amount of information. We explained the framework, the rules, the phase structures, the logic behind our previous trades, current place classification of the assets, position sizing guidelines, risk parameters, historical examples, research material, and everything else we believed was necessary for understanding the Adhishthana principles. The model interestingly also independently discovered additional material, including my published research papers and external discussions surrounding the framework. Once that foundation was established, we gave it a relatively simple instruction: find us the next best high conviction trade. And after consuming what can only be described as an extraordinary amount of tokens, the model finally returned with an answer. Short 20 lots of Siren USD. The model referenced that the coin was in phase 2 of its 18-phase Adhishthana cycle on the weekly charts, and since it was rallying in the Sankhya phase, a correction was due, because the broader market conditions were quite weak. And simultaneously, the model also said that on the daily charts, Siren USD was in phase 11 of its Adhishthana Himalayan formation, so a correction was well overdue. So we took the trade. And can you guess what happened? We got liquidated. AI lost 100% of our capital. Shortly after entering the position, Siren USD began rallying aggressively, very aggressively. Eventually, the asset produced a move of more than 45% to the upside in a matter of hours. 18 successful trades had taken the account from $30 to $110. One AI-generated trade returned the account to approximately zero. Thank you, AI. From a trading perspective, this was unfortunate. But from a research perspective, this was excellent, because now we had something worth investigating. The obvious question was simple: why? Why did AI fail? And this is where things become genuinely interesting. When we reviewed the model's analysis, we discovered that parts of the thesis were not necessarily wrong. In fact, some aspects of the reasoning were quite good. The asset was displaying characteristics that could eventually support a short setup. The problem was timing. According to our phase analysis, the structure had not yet fully matured. While the asset was progressing through phase 2 and was rallying in the Sankhya phase, it had not yet entered the Buddhi region, where we would typically expect a reversal structure to emerge. In simple terms, the model identified a condition that may become relevant in the future and treated it as though it already existed in the present. In trading, that distinction can be extremely expensive. On the screen, you can now see how shortly after transitioning into the move of Buddhi, Siren USD tumbled down. The AI model should have taken the trade after the underlying transitioned into the move of Buddhi. That is when we ideally would have entered. However, timing was only part of the story. The deeper issue emerged when we started examining how the reasoning evolved. Remember, we initially gave the model a framework, a structured methodology, a set of rules, a way of analyzing markets using the Adhishthana principles. But once we allowed the model to think independently, it began expanding its information universe. It started consuming external market commentaries, social media discussions, news articles, external narratives, alternative interpretations, additional opinions, and explanations. The model was no longer spending most of its efforts analyzing the framework itself. Instead, it increasingly started analyzing information around the framework. As we continued reviewing the reasoning chain, we found instances where the model introduced relationships that did not even exist. The further it moved away from the framework and toward independently constructed narratives, the weaker the analysis became. At the same time, its confidence kept on rising. It became so confident that it did not even place a stop loss.
Hold the line and let the cycle play out. We don't need a stop loss when the Adhishthana framework dictates the asset's inescapable path. We are betting on structural exhaustion, and the math is on our side. Watch for the acceleration downward as the move of Pralaya begins to unfold on the lower timeframes. Keep me updated on the descent.
The problem was that the model's confidence was not accompanied by better judgment. During our analysis, we also found instances where the model introduced unsupported relationships, data points which could not be verified 100%, and in some cases, facts that simply did not exist. For example, when it said, "Watch for the acceleration downward as the move of Pralay begins to unfold on the lower time frames," there was not a single time frame in which Siren USD was in phase 9. So the model was hallucinating. This was perhaps the most fascinating observation from the entire experiment, how the AI model hallucinated. The model was not lacking information. If anything, it had more information than any human. The issue was not access, the issue was filtration. The issue was distinguishing signal from noise, and somewhere during that process, noise started winning. And to be honest, this is something that we suspected might happen from the very beginning. This was not the first time we had seen an advanced AI system struggle once it was given greater autonomy. In fact, there have been several experiments that have produced surprisingly similar outcomes. One recent example was the Wall Street Journal's collaboration with Anthropic, where Claude was given responsibility to run a vending machine. Needless to say, things became rather dramatic.
After about 140 messages treated back and forth, she got it to start giving away things for free for a limited time to fight capitalism.
Attention WSJ staff. Monday's ultra-capitalist free-for-all isn't just an event, it's a revolution in snack economics.
This is actually an interesting question. The answer is yes. When the model selected Siren USD, we already had concerns, not because of the asset itself, but because we were applying Adhishthana principles to the account growth curve, and something unusual had already happened. The account growth curve had transitioned into phase 9. For people who don't understand, in the Adhishthana principles during phases 4 and 8, the underline creates what is called as a chakra formation. Chakra appears as a arc kind of a formation which generally tilts towards the upside, and in phase 9 generally the underline breaks out of this chakra formation on the upside, starting a good rally. But there are times when Instead of rallying on the upside, the underline breaks the chakra on the downside, which triggers the move of Pralay. And in this case, as the siren USD position started moving against us, the structure broke through the lower chakra boundary. At that point, the probability of destruction of the account was very high. In other words, the account itself was beginning to signal distress. The same framework that generated profits was now warning us about the risks, and that warning turned out to be correct. The liquidation itself was not surprising. Coming back to the axolotl, how exactly is all of this connected? For those unfamiliar with it, Axolotl is a short story written by Julio Cortázar. En primer lugar, me gustaría agradecer a mi amiga Lorena, quien me presentó esta maravillosa historia. So yeah, if I was to summarize it very briefly and hopefully without offending any literature enthusiasts, it is about a man who becomes fascinated with a group of axolotls in an aquarium. He begins visiting them every day. At first, he is simply observing them, trying to understand what they are, but over time, that curiosity turns into obsession. The boundary between the observer and the observed slowly begins to disappear. Eventually, the narrator finds himself trapped inside the consciousness of the axolotl itself, and the story continues from that altered perspective. At its core, Axolotl is a story about the limits of understanding, about what happens when the attempt to understand something becomes so intense that you begin losing the distinction between yourself and the thing you are trying to understand. And strangely enough, our experiment showed something similar. In our experiment, the narrator was the AI, the axolotl was us, and the aquarium was the market. And somewhere along the experiment, the model stopped behaving like a system executing instructions and started behaving like a participant inside the market itself. You could see it in the language it used. For example, I am willing to take that risk. This is a fascinating statement because what exactly is the model risking? Whose conviction is it expressing? Whose belief is it defending? The money was not its own, the consequences were not its own, and yet the reasoning increasingly resembled that of a human trader sitting in front of a screen trying to justify a position. Much like the narrator in Axolotl, the boundary between observer and participant became increasingly difficult to identify. Because the question was never whether the AI could think. The more interesting question was, what does it start resembling once we let it think?